price tells you where the market went. Volume tells you whether anyone meant it. Today, we're dissecting volume spikes as a confirmation tool for advanced traders. You'll learn the math behind a spike, how to read it in context, where it lies to you, and how to combine it with structure for higher conviction entries and exits. Think of volume like the roar of a stadium crowd. A team can score, but if the stands are silent, something's off, maybe it was a practice game, maybe the goal gets reviewed. When price breaks a key level and volume roars 2 or 3 times the average, the crowd is validating the move. When price breaks out into silence, expect that breakout to be reversed. Volume is the audio track to the price movie. A spike isn't a feeling, it's a measurement. Standard practice: compare current bar volume to its 20-period simple moving average. A ratio of 1.5 is notable, 2 is significant, 3 or more is a genuine spike. For statistical rigor, some traders use z-scores, volume minus the mean, divided by standard deviation. A z-score above 2 flags an outlier bar. Normalize, then interpret. The cleanest signal: price breaks a horizontal resistance that's held at least twice, and the breakout bar prints volume at 2 times average or more. That spike says institutional orders are absorbing offers and stops are triggering. Without that spike, you're often looking at a liquidity grab. Price pokes above, finds no follow-through buyers, and reverses into the range. Not every spike is bullish confirmation. After an extended trend, a massive volume bar can signal exhaustion: the last buyer just bought, or the last seller just panicked. Look for spikes 3 to 5 times average appearing with a wide range bar that closes poorly relative to its range. That's distribution into strength or capitulation into weakness, and it often marks a swing high or low. A spike's meaning depends on where it prints. At support after a downtrend, heavy volume with a hammer suggests accumulation. Mid-range, heavy volume often means nothing, just noise from a news headline. At resistance with a shooting star, it's distribution. Always anchor volume analysis to the structural level the bar is reacting to. Location first, magnitude second. Single bars can mislead. On-balance volume cumulates signed volume, adding on up days, subtracting on down days. When price makes a new high and OBV confirms with its own new high, the trend has participation. When price climbs but OBV drifts sideways or down, you have negative volume divergence. The rally lacks fuel. This is one of the most reliable Confluence tools advanced traders underuse. Look at Apple on the daily. Find a session where price closes through a multi-week resistance and the volume bar towers over its 20-day average. That's your trigger. Entry is on the close of the breakout bar or on a low-volume retest of the broken level. You're in validation. A close back below the level on rising volume, that means sellers reclaimed control and the spike was a trap. Spikes lie in 3 common ways. First, scheduled events, earnings, Fed days, index rebalances generate volume unrelated to technical structure. Second, low-float stocks spike on tiny absolute share counts that look dramatic but mean little. Third, opening and closing auctions distort intraday volume profiles. Always know the calendar, the float, and the session before trusting the bar. Stack your edges. Combine a volume spike with a break of a Donchian channel, a VWAP reclaim, or a Bollinger Band expansion out of a squeeze. Add a momentum check from MACD or RSI moving with the breakout, not against it. When 3 independent signals agree structure, momentum, and participation, your hit rate climbs meaningfully versus trading volume alone. 3 traps to avoid. Chasing late: by the time a spike is obvious, the easy move is often done. Wait for the retest. Ignoring the close: a spike with a doji or rejection wick is not confirmation, it's a warning. And confusing volume with volatility: a wide range bar can print on average volume, which means players are absent, not committed. To recap, define spikes mathematically, anchor them to structure, beware exhaustion at trend extremes, and use OBV for cumulative confirmation. Tomorrow, open your charts, mark the 20-period volume average, and review your last 10 breakout trades. Did the winners have volume confirmation? Did the losers lack it? Let the data refine your filter. This is education, not financial advice. Trade your own plan, manage your risk, and I'll see you in the next one. If this helped, do me a favor, hit the like button, subscribe, and tap the bell so you don't miss the next one. See you in the next video.